Good morning, all you beautiful people in the credit union community. I have no idea if it's the morning where you are, but it is the morning here for me. First up, credit unions added nearly 3 million new members last year. But get this, almost 2/3 never made a single deposit. Next up, nearly 60% of software buyers regret their recent purchases. And it's not because they chose the wrong product. And last but not least, the Trump administration's solution to unaffordable housing is a 50-year mortgage. What role should credit unions play in helping members achieve home ownership? Welcome to Grow Your Credit Union. This is the podcast where credit union leaders gather, learn, and grow. I am your host, Joshua Barclay. Before we begin today's show, I want to first mention our sponsor, the National Credit Union Information Sharing and Analysis Organization. Their acronym is very long. I had trouble saying it. I had to stare in the mirror repeatedly saying, "How now, NCU-ISAO?" But that is the acronym. They are called NCU-ISAO. NCU-ISAO helps credit unions strengthen their cybersecurity defenses by delivering real-time threat intelligence, expert guidance, and a trusted community for sharing and staying ahead of emerging risks. You will hear more about NCU-ISAO later in the show. Becky Reed, I feel like I haven't seen you in many, many moons. Welcome.
Howdy, y'all.
Howdy, Becky. It's very, very nice to see you. I don't know why. I probably saw you last week. I don't know. I don't remember anymore. But I'm back from Brazil. I celebrated my 40th birthday out there. It was lovely. I got sunburn. I rode on the back of a moped. Have you been to Brazil, Becky?
I have not been to Brazil. I've been to Latin America, but I have actually never been to Brazil.
So I was impressed because Sao Paulo, the city there, is actually comparable to New York City. It's the only city I've ever been to where if you dropped me off with a blindfold and then took the blindfold off and told me that I was in New York City, I would believe that I was in New York City. But I also thought it was funny, like some things like Uber, they have motorcycle Ubers. So like you call a guy and he picks you up and you get on the back of his motorcycle.
Oh my goodness.
So like safety and regulation, I don't know if Brazil's really a stickler for safety regulations, but some guy pulled up on a motorcycle and I just grabbed the back of him and hugged him and held on for dear life.
You know, that reminds me of Pulp Fiction, right? Where it's just the little differences.
Yeah, the little differences. So I'm 40 now, Becky. So let's see if I'm better, if I'm new and improved. We'll bring in today's guest. He's a return guest. He's a close friend of the show. And like Becky, he's a Texan. Let's give a cowboy-approved welcome for today's guest, the Executive Vice President at Texans Credit Union, Mike McWethy. Mike, yeehaw and howdy, my friend.
Well, howdy, y'all. It's good to be here. Thanks for having me back. Excited to talk with you guys.
Do you think that you can tell that I'm not a Texan if I come up to you and say yeehaw and howdy? I don't think I can do both of those, right?
Yeah, neither of those I think you're saying right, but I can't put a pin on what that is, but I don't know. Maybe if you're wearing a cowboy hat or something, I might be able to pull it off.
Credit unions, they welcomed 2.9 million new members last year, which sounds like a win. But here's the catch, Mike and Becky. 64% of those new accounts never made a single deposit or showed any real activity. That's according to the NCUA. In his recent article, Harai Khalsa points out how brands like Starbucks use simple, immediate incentives to turn first-time users into loyal, habitual customers. An approach that, I don't see credit unions really using that type of onboarding process. Mike, many credit unions, they rely heavily on welcome emails. What do you think should replace or enhance that approach to actually get new members activated?
Well, that would be kind of tough to just lean on an email for that. You know, the open rate and read rate of emails is declining and very low. That just doesn't work today. You get hundreds, if not thousands a day that you ignore, and people are just going to ignore that one. And so I think there's a multi-prong approach. I think he's right. There is just a large amount or a high percentage of members that are closing their memberships each and every month at every credit union based upon just a lack of connection. And how do you do that? The studies I've looked at really looked at the onboarding really is the time to do that, where you're setting the stage for the relationship. And so how do you elevate that? I think a few things that can be done is first investing in some sort of relationship software or build it in which you have routine engagement they understand the life cycle of the member and say the right things at the right cadence based upon the channel that they came in or the products that they chose. And that's difficult choosing that partner, but that takes somebody at the wheel for a long time building that out in order to make sure that you do that right. And it's not just emails, there's texting and other things. One of the things that we've done is create relationship advisor roles at our organization. So whenever a member onboards with us, they get a human connection on the phone and speaks to them about what the credit union is. Some people don't even know the difference between a bank and a credit union or really understand what we can do for them, and see if there's opportunities to uncover things like credit counseling or help you improve your capacity each month and the products and services we have. And so I really think that's where credit unions can potentially shine, is the human connection, building trust with the members rather than just doing a transaction. So that takes an investment, though. We know that was an investment of salary expense, and that could grow into a really heavy burden for us. But if that's where we think the differentiation is, well, then we need to do that. And then there's also tracking metrics. I'm always interested in random things like how good is the relationship of members that come to the indirect channel versus in the branch versus digital account opening versus they just wanted to have a auto loan with us. What's the average value or engagement of that member? And there's different lenses to look at: products per member, member engagement, things like that.
Becky, kicking it over to you. So if emails are not the method to do onboarding properly and engage new account holders, what is? What alternatives do we have?
So I'm going to sort of answer your question, but I am going to tell you what I read into that data. What you said is NCUA says we added 3 million members to the credit union ecosystem in last quarter. Yay, great, but none of them made a deposit. Well, let's think about why. And let's think about how members are actually joining credit unions today and why in the world would they join if they're not making a deposit? The reason for that is because they're coming in through indirect lending. What you didn't hear from NCUA is what other products those people have other than a deposit product. Many members for credit unions come in and become a member because they got a loan through a dealership. They don't have to make a deposit. They see us as a finance company. They don't open their checking account with us or do any other deposit account transaction with us because they got a loan with us, which, by the way, is one of the major reasons people join a credit union. Everybody knows, they might not know even what the heck a credit union is, but what they do know is you usually get better rates when you get your loan through a credit union. So now we're going to switch into the engagement piece of it, right? So a credit union, Mike's credit union size, if they do an indirect lending program, they probably get hundreds of new members every single month just from indirect lending. Hundreds. If you don't have an engagement piece that tries to bring those members into the credit union, regardless if it's digital or if it's a human being, you're probably not going to convert them. And it's really hard to convert them. It has been historically hard to convert them because those people are not joining to make a deposit. They joined because they got a loan from the credit union. And so we have had a terrible, terrible record of converting those folks to being full-fledged members. So I always like to read a little bit more into the data and really think about why, because just on the surface of that, it makes zero sense that somebody would go to the trouble of going online, filling out all the paperwork, doing all the KYC information, blah, 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 and not making a single deposit. Two reasons that I can think of why that happened. I already talked about one, that's indirect lending. The second reason is we make it so freaking super hard to make that first deposit. So it stops. It stops there. Now, what we've done at Bank Social is we've added cryptocurrency as a way to open the account, right? So somebody can open an account with a stablecoin or Bitcoin or Ethereum or something like that. It needs to be a simple process. And historically, credit unions are super, super terrible at making payments simple.
When choosing the right vendor, credit unions often focus on feature checklists while overlooking what actually determines long-term success. It's the quality of the partnership, folks. According to Capterra's Tech Trends report, nearly 60% of software buyers regret their recent purchases, and over 30% blame poor service, not the product itself. So for credit union leaders, this means vendor selection isn't just a technology decision, it's an exercise in character judgment. Mike, I want to kick this off with you. What is one red flag that would immediately remove a vendor from your selection process?
Well, I definitely have some recency bias on this. I'm still reeling in guilt from choosing a business partner to do business with. And, you look 18 months later and we're having to spin up the team again in order to find a replacement for it. And I am horrified by the time, energy, salary expense, whatever it is that we allocated towards that. And it's painful. And I don't want to do that again. And so it really sensitizes you a little bit to those details that you're talking about. You look back in retrospect, what did I not see? What were things that I should have been more sensitive to? I think relationship matters. That was sort of your lead in all this is, do you trust the individuals that you engage? What's the sense you get from them? And then what are some references that you get? There's all sorts of things to look at. But for us, we're trying not to be close to the bleeding edge where you're involved with a startup who is also struggling with trying to buy into a lot of things. Do they have a track record of at least one successful engagement? So the burden isn't on us in order to handhold that vendor in order to get to where they are providing real value. And we got to get more people involved in the decision making. I probably took up a lot of the oxygen in the room whenever we made that vendor selection that time. And I'm, now I want to be far more quiet at the table whenever we're making these vendor decisions. And I can't emphasize references enough. Do they have references and what's the quality of those? And if they hesitate in providing that information, good references, or they're not quick to responding to you, the red flags should start appearing, where you start to slow down a little bit.
Mike, you said you had recency bias with a bad experience. Without obviously saying too many details, is there one thing when you look back on that where you're like, that was a red flag and I didn't see it?
Yeah, it was whenever we were talking about roadmap of the software, there was a lot thrown out of idealistic things that are on their roadmap. And the proof of concept that they can achieve the things that were on the roadmap was unproven at that point. That should have resonated with me. That should have been something that I leaned into or slowed me down a little bit because I just overly trusted that they were going to march down that roadmap in a reasonable time frame. And that just didn't come to fruition.
So for you now, Mike, moving ahead, if I'm a vendor and I've got a roadmap and I'm, whispering sweet nothings in your ear about where the direction we're going and all these cool things we're going to do, if I don't have a proven concept, if I haven't done that with another credit union, are you simply going to say, look, I'm not buying it?
Well, not at this time. That's just the case. I'll probably say, show me what your roadmap was 1-2 years ago. And then I could see the items that you checked off that roadmap, that you have proof of concept that you did some things. And if that's just not something that can happen, I don't want our organization to bear the burden of risk of those things not coming to fruition. And then we're sitting here 2 years later trying to spin up the team again in order to distract the organization again. I'm too sensitive to it right now. We can't afford to do that at the pace of change.
Becky, red flags when assessing a vendor. Your thoughts?
It's hard because it depends. And I think that to Mike's point about an emerging technology company that is doing things that are new, like, for example, if you want to implement agentic AI, you're not going to find a company in the space that's 10 years old. Probably not going to happen. Now, you might find a chat vendor that has incorporated agentic AI into their legacy platform. You might find that, but there's risk there too, because they've changed their business model. So what they were doing 10 years ago, now they've incorporated something new and they're doing something new that they've proven that their model 10 years ago works, but they may not have proven that the model they upgraded 8 months ago works. And so it's kind of a double-edged sword. If you want to engage with companies that are doing things that are newer, there are risks to that. And all of the things that Mike is talking about are 100% true. Yes, you need to see a roadmap. Yes, you need to have a product that's in production. But all of this just goes back to the risk appetite of the credit union. If you are unwilling to take a risk with a newer technology because it isn't 10 years old, then that's a risk in and of itself. But that might be your risk tolerance at the credit union, and that's okay. One of the challenges we have in our industry is we tend to be followers and not leaders generally, because being a leader and taking a risk with a vendor that is doing something new, there are very, very few credit unions that are willing to do that. Now, the ones that are willing to do that might only be willing to do that with a particular use case. Like, for example, if you're going to get a brand new digital banking, okay, let's say you're going to do a brand new digital banking and there's this vendor that has this bright, shiny, wonderful digital banking that's like, holy cow, I want that. But they don't have a single client live on it. And you're like, dang, but I want that. I want what they're doing. Well, possibly you could roll that digital banking out to 10 members and do a proof of concept just to make sure that it works and it's being built in the way that you want to. But that's more of a partnership opportunity, right? That's not just buying a product that you can take off the shelf. That is working with that vendor to build something that's never been done before, which is a completely different concept than just signing a contract, paying an implementation fee and a monthly service fee and going on down the road, which you would do with a vendor that's been around for 10 or 15 years. You cannot do that with a new product or a vendor that's only been around for 2 years. So I have felt Mike's pain. I'm going to tell you, I have felt Mike's pain. I had a vendor experience where I needed them to build me a report with a core that I had just converted to. It should have taken 2 weeks. It took a year. Now, I didn't pay anymore. Okay, I didn't pay anymore. They didn't charge me more, but just the time it took to implement cost me money, which is what Mike is experiencing right now. I don't know what the solution is. All the red flags he mentioned are 100% absolutely true. The trust factor is very important. One of the things we did at Lone Star Credit Union is if the vendor's culture didn't match ours, we didn't sign with them. It didn't matter if they were 10 years old or a year old. So, I think that's important. Are they responsive? Are they giving you the information you need? Are they being transparent? Look, if I'm going to tell you right now, if Bank Social showed you the roadmap from 2 years ago, we've done a lot of it, but there's a lot of stuff on there that we chose not to do because it didn't work. It wasn't the right time. We couldn't find a client to buy it, whatever the case may be. But I can show you that, there are products in production, or if there's something on the roadmap, I can tell you, this is just a concept right now. We've built the framework, but it's not even fully built yet. So that transparency, I think, is important.
Cybersecurity threats are evolving faster than ever, and credit unions are increasingly in the crosshairs. But you don't have to face those threats alone. NCU-ISAO is the only organization fully dedicated to protecting credit unions, their members, and the cooperative movement through real-time information sharing, expert-led analysis, and a rapidly growing community of security-minded professionals. When you join NCU-ISAO, what do you get? You get access to timely threat intelligence, actionable alerts, exclusive member briefings, and a network of peers who understand exactly what you're up against. Whether you're a small credit union with a lean IT team or a large behemoth looking to elevate your security posture, NCU-ISAO helps you stay ahead of emerging risks before they impact you or your members. Strengthen your credit union's defenses with the power of collaboration. Join today at NCU-ISAO.org/GYCU. NCU-ISAO, protecting the movement, one credit union at a time. The political climate is contentious, but there's one thing almost every American agrees on. Home ownership is too dang expensive. The Trump administration recently proposed a 50-year mortgage as a solution. On paper, it lowers monthly payments, but borrowers could pay more in interest and build equity far more slowly. I was thinking, reading about this, I'm not locked into the idea of a 50-year mortgage. I don't want us to fixate on the 50-year. It's more about alternatives to home ownership, right? So for credit unions, I'm wondering, should they be offering products or services to help make home ownership more attainable for members? Mike, when a member says to you they can't afford a home, what do you think credit unions should actually be solving for? Is it the monthly payment, or is it something much deeper than that?
It's two things. It is the monthly payment, but it's also the obstacle of coming up with the money down in order to get into the home. And I do think that there are some things that can be done. It is heart-wrenching that is the biggest issue. And I understand the 50-year mortgage idea because, in America, a major source of wealth comes from home ownership, and people are just not able to do it. The median age now is 59 for a home. It's insane how difficult it is. I know my insurance payment has gone up. The insurance portion of my monthly payment is insane at this point, and property taxes and all those things. I loved seeing my property value go up over the last 5 years, but man, that came with property taxes that impacted my monthly payment. So that's what we're seeing is a twofold thing. Is even if you do have consumers, like right now we have a first-time homebuyer program where we finance more than 100% of the purchase in order to help first-time homebuyers into their home to overcome that obstacle of not having enough money down. So we've got a solution for that. But the reality is that doesn't mean that they can still afford the monthly payment of that home because it is outrageous. Happy to see mortgage interest rates are starting to slide down a little bit. We love that the Fed reduced their overnight rate here recently, but slightly different than what the mortgage interest rates are. So we'll see how that impacts it. But I don't think, even if rates were to continue to slide down, even another 100 basis points, that would effectively lower the monthly payments for home ownership enough to make it make sense for the people currently paying rent. There was a study I looked at the other day that talked about just home ownership really doesn't make the same sense that it did before, simply because of property taxes and homeowners insurance being so high. And so for us, we rolled out recently the first-time homebuyer program to deal with the down payment issue. Now we're scratching our heads trying to figure out what are all the things that we can do and help getting monthly payments down. Is it the 50-year mortgage? That doesn't make you feel good. That's you only over a decade, you'll have a 4% reduction in your principal, right? That doesn't make you feel good offering a product like that, because how are you going to be able to build equity in your home? You just simply won't. So it might make sense to somebody who knows that they're going to be in their home for a short amount of time. If I'm going to be in this home 5 years and I just want a lower monthly payment by a couple $100, okay, maybe that makes sense for you. Hopefully, if you're wanting to live in that home until retirement, you decide not to do a 50-year mortgage. And so for us, it's like, well, first-time home buyer, but also what about a product in which you have a lower interest rate, like an ARM that offers a different lower rate in the beginning while you're trying to get your feet under you as a homeowner, especially I remember trying to get in my first home and like, oh, I now need to buy blinds and furniture. I am broke. That pain, how do you help with that? And I think perhaps an adjustable rate mortgage might be something with that. And also, I don't think realtors are doing enough, at least some of the ones that I've engaged in, helping people understand that there are different property tax rates for different areas that you're in. And there's also different insurance costs based upon the areas that you live in. And that really matters in today's environment. And so we're trying to put in a little more effort into helping people uncover what their insurance payments would be and guide them to get those premiums right away whenever they're looking at a home, and understanding the differences of impact for property tax rates in different areas in order for them to understand it's a sliding scale based. A $500,000 home has a very different monthly payment in certain regions of the Dallas-Fort Worth area where we're primarily at. So what are the right areas for them to maintain the lowest monthly payment possible? We don't have it all figured out. We also try to help them boost their credit score if that's going to be something, or help them understand with down payment assistance programs if they didn't qualify for first-time home buyers. There are many things we do, but man, it becomes a much heavier burden on the organization in order to assist with that white glove service. I think that's where we differentiate. I think we're called to do that as credit unions, and we want to do that, but it becomes a heavy burden trying to carry that. But I think that's what's needed right now.
Mike, really honest take from you. I really appreciate that. I appreciate that you mention all the costs, because I don't think it's not just the mortgage. It's not just the rate. Like, I bought a house last January and I feel like Rockefeller. I'm like, how the hell does anybody do this? Because after the mortgage, your utilities and the taxes and the it's like, I'm dropping massive amounts of bread on a very basic ass house right now, if I'm being completely real with you. Becky, where do you see credit unions' role in trying to help homeownership be more attainable? Or is that not our responsibility, quite frankly, like if we're just being real?
First of all, I love everything that Mike said, because it's a great example of our credit union heart. Everything that he talked about was helping the member, everything. None of it had to do with what kind of loan products are we going to do to make more money at the credit union. That's not how we roll. I really love that. I love the no down payment first time home buyer program. That's absolutely incredible. I love that. But times are different. The mantra used to be, like when I was growing up, you had to buy a home. We got into a home very, very early because our parents were like, home ownership, you have to do that. We're kind of repeating that mantra to our son, my husband and I, a little bit. I'm not sure that's the right thing to do right now, for all the reasons you both mentioned: property taxes, utilities, all of those things are astronomically more expensive than when you rent. And yes, by renting, you're not gaining equity in the home. I understand that. But, you have to look at the outlay of cash now, the difference between if you're renting and buying. Take that difference. Let's say it's $1,500 a month different, higher, whenever you're owning a home. Put that money into Tesla stock, and what's the long-term outcome of that versus the equity you might earn in a home over that same time period. So I think wealth management might be an opportunity, sitting down with a member and looking at all of the options, including home ownership, including renting, and taking a look at all of that from a financial planning perspective when someone's 25 years old, and saying, what makes the most sense for you now? As you get into your higher wage earning years, is it better to continue to rent until you get there? And then by then, save up more for a down payment? I don't know. But I think that we have to change as an industry and start looking at perhaps the dream of home ownership is not the right dream for everyone.
Becky, I want to come back. I don't want to lose this opportunity before we close on the 50-year mortgage, because I do want to quickly get each of you Mike kind of talked about it a little bit. I just want to briefly go over this. Becky, the 50-year mortgage idea, what do you think about that?
I think it's crazy, but there's some areas in the country, the housing prices are insane. You get a 1,200 square foot house that was built in 1920. It cost you $3 million. If you're in Los Angeles, that's what you're facing. New York City, that's what you're facing. It's like, what in the heck is happening there? How can anybody afford that? And so all kinds of creative lending products have to be built around just being able to make sure that somebody can afford the payment to a $3 million house. So, I agree with Mike. It's like, okay, if the 50-year mortgage makes sense, if you're just going to make the minimum payment and you're going to sell the house in 5 years. Okay. Maybe you'll get a little bit of equity out of it, but at least you'll have a house for 5 years that may be more expensive in the long run than rent. So the 50-year mortgage thing just makes me crazy. I don't think anybody would get a 50-year mortgage and expect to stay there for 50 years. I don't think that's realistic.
That brings us to the end of the show. Mike, I always do final thoughts. Give me yours.
Well, A few things on each of the topics. I think Becky's right. I think there's much more to be said. I would love to talk about that, from how do you onboard people and why are they not doing deposits? I think there's another topic in there, and that's the deposit products that we offer as organizations and the speed and ease in which you can make those deposits that she was talking to. So I think there's a lot more there to talk about. Becky's also right. If you're trying to set your stage as an organization to be appealing, you sometimes have to take risks on the front end of the products that you offer, and you might have to be involved with people a little bit closer to the bleeding edge of what's out there in order to differentiate your brand, and that's just a risk. And how many can you do? 0, 1, probably not 2 at a time. That's difficult to do. And then the last thing, about the 50-year mortgage again, what would scare me about that is what if it is successful? What do you think is going to happen to the $2 million homes across the United States if 1 million people were eligible for a 50-year mortgage? The price of those homes will continue to escalate. And that's really part of the problem that we're in right now. So I don't think it's a winner, but we'll see what happens with it. And by the way, our mortgage program's growing like crazy because it's been pretty successful, the things we've been doing. So if you know any mortgage processors out there, we could use a few of them, as we're running and gunning pretty well. So pretty happy with what's happening with us, and we'd like to see where that goes.
Mike, if somebody wants to get in touch with you, what is the best way to do that?
Mike_McWethy at texanscu.org.
Okay, Becky, final thoughts.
Well, I always love having Mike as a guest, and I love Texans Credit Union. They have a special place in my heart. I worked there for a period of time, and it's a fantastic organization. All credit unions do great things for their members, but just Texans has a special place in my heart. So I always love talking to Mike and the folks there at Texans. I actually want to talk about NCU-ISAO. I think
you could say it.
NCU-ISAO. Yeah. I was a member, my credit union, when I was a CEO, Lone Star was a member of theirs, and Pure IT, our QSO, is actually very closely partnered with them. They do a conference, a CU Intersect conference. It's actually going to be in New Orleans this year, or next year, actually, in January.
And Becky, guess what? I got to cut you off, because in January, we, Grow Your Credit Union, we will be at that
There you go.
CU Intersect conference in New Orleans. So go ahead, Becky.
And it's great. It's all about cybersecurity, and it's just a fantastic organization. And so I'll give a plug there to our sponsors. Thanks.
Thank you, NCU-ISAO. And Becky, I know how people can get in touch with you, but you got to tell them. How can they get in touch with you?
LinkedIn, baby.
All right. I want to thank our guest, Mike McWethy. I want to thank my co-host, Becky Reed. Thanks to our sponsor, NCU-ISAO. And a special thanks to our listeners for continuing to support and listen to another episode of Grow Your Credit Union. If you like the show, follow us on your podcast player of choice. If you want to be a guest or would like to talk about sponsorship opportunities, head to growyourcreditunion.com to learn more. Thank you very much for listening. We will see you next time. Take care. Bye-bye.